Welcome to my presentation, Property Valuation for Beginners, Part 3. In Part 1, we were discussing about the valuation method as per landed building method. In Part 2, I have explained the other methods like rent capitalization method, composite rate method, and valuation of flats. In Part 3, we are discussing about rent capitalization method, development method, and profit method. Just like the Part 1 and 2, here also the methods are explained more by worked out examples than by theory. Rent capitalization method. Normally, all the properties which are tenanted, leased or licensed are valued by the rental method of valuation. However, in many occasions, vacant or owner-occupied premises are also valued by rental method by estimating the probable market rental for the premises. In such cases, great care should be taken in selecting the yield rate after a proper and accurate market survey. Otherwise, it will mislead to a wrong result. The following case studies describes how rent capitalization method is used to find out the market value of rented property. The rent capitalization method for owner-occupied properties are explained after the rented properties. Case studies. Case 1. A fully developed building yields a gross annual rent of rupees 50,000 per annum. The outgoings works out to rupees 25,000 per year. If the expected rate of return is 7%, find out the market value of the property. In this region, the Rent Act is in force. So the data, gross annual rent receivable rupees 50,000 per annum. Deduct outgoings in a year rupees 25,000. Net rent receivable per year is equal to 50,000 minus 25,000 is equal to rupees 25,000. Rent Act is applicable. Net yield is capitalized as 7% in perpetuity. Market value of the property is equal to 25,000 in the 100 by 7 is equal to rupees 3,57,143. The theory is the rent received 50,000 is at the rate of 7% in perpetuity. So the net rent is 25,000. So 25,000 is the 7% of the total. Hence, what is the total? What is the 100%? That is equal to 25,000 into 100 divided by 7 is equal to rupees 3,57,143. Then, as per the formula, for years at perpetuity, it is 1 by R. That is 1 divided by 0.07. That is equal to 100 by 7. Case 2. A ground plus 3 upper floors RCC fully developed building is fully rented to 8 tenants in each floor. The rent per ground floor tenants is rupees 600 per month for each flat. The tenants in first floor, second floor and third floor pay a rent of rupees 650 per month, 700 per month and rupees 750 per month per each flat respectively. The outgoings are land tax rupees 250 per year, building tax rupees 30,000 for 6 months, insurance premium rupees 1,000 per year, common light bill rupees 100 per month. The building is 25 years old and the expected rate of return in real estate market is 9%. The building is located in a town where the Rent Act is applicable. Solution. Rent for the ground floor per annum. 8 flats into 600 into 12 is equal to rupees 57,600. Rent for first floor is equal to 8 into 650 into 12 is equal to rupees 62,400. Rent for second floor per annum 8 flats into 700 into 12 is equal to rupees 67,200. Rent from third floor per annum is equal to 8 into 750 into 12 is equal to 72,000. So gross rent per annum is equal to rupees 2,59,200. I have adopted a very detailed calculation for the gross rent since it is being presented for the benefit of beginners. I expect all to practice a easy and quick method on the point of view of the exam. So here gross rent is equal to rupees 600 plus 650 plus 700 plus 750 into 8 into 12. This should be the method you should follow for the examination. So the total gross rent per annum is equal to 2,59,200. Less outgoings. Land tax per year 250, building tax 30,000 per 6 months. So for 1 year 2 into 30,000 is equal to 60,000. Insurance premium per year 1,000. Common light bill 100 into 12 is equal to 1,200. General repairs 10% of gross rent. It is about 10 to 15%. Here I am assuming 10%. If you want, we can assume 15% also. So the rent is equal to if 10% of the gross rent is equal to rupees 25,920. Collection and management 2% is equal to rupees 5,184. So total outgoings comes to rupees 93,554. So net annual rent is equal to rupees 2,59,200 minus 93,554 is equal to 1,65,646. Capitalizing net yield at 9% in perpetuity, we get market value is equal to 1 by R is equal to rupees 1,65,640 divided by 0.09 is equal to rupees 18,40,511. Note, in the rent capitalization method, it is very important in selecting the proper rate of capitalization. The valuer has to get himself educated by observing various examples. The importance of selecting correct rate of return can be explained by selecting the 3 different types of occupancies and working out the value in each case. The different categories of occupancy are given below. 1. Occupancy of a tenant protected by Rent Control Act. Occupancy of a licensee protected by easement right. Then occupancy of lease protected by Transfer of Property Act. In going through the history of real estate market, it is found that it is very important on the part of the valuer in selecting the proper rate of capitalization for each occupancy. The yield rates are generally adopted for different occupancy are as given below. 1. Rent controlled property, 9% yield rate. 2. Licensed property, 4% yield rate. Leased out property, 6% yield rate. Rent controlled property is 9% yield rate. Licensed property is 4% yield rate. Leased out property, 6% yield rate. The following case studies will explain in detail about market value of properties of different occupancy. Case 1. Rent controlled property. A fully developed ground plus 2 upper floors is fully rented for the first time in the year 1980. There are 5 tenants in each floor. The ground floor tenant pay a rent of 500 per month per tenant. First floor tenants pay a rent of rupees 550 per month per tenant. Second floor tenants pay a rent of rupees 600 per month per tenant. The outgoings are land tax per year 500 rupees, building tax rupees 9,000 in 6 months, house insurance rupees 800 per year. Work out the market value of the property if Rent Control Act is applicable. Assume appropriate rate of capitalization. Please note, here the property is located in a town under Rent Control Act and the valuer has to assess the appropriate rate of capitalization. Gross annual rent is equal to 500 plus 550 plus 600 into 5 into 12 is equal to 99,000. Land tax per year 500. Building tax per year is equal to 900 into 2 is equal to rupees 18,000. House insurance rupees 800. Repairs 10% of gross rent is equal to rupees 9,900. Sweeper and common light 500 into 12 is equal to 6,000. Collection management 3% is equal to 2,970. So total outgoings is equal to rupees 38,170. Net income or yield is equal to total annual rent 99,000 minus the total outgoing rupees 38,170, which is equal to rupees 60,830. Since the property is rent controlled, rent company is frozen. Hence, a rate of 9% is considered as appropriate rate of capitalization. Capitalizing net annual yield at 9% in perpetuity, the market value is equal to rupees 60,830 into 1 divided 0.09 is equal to rupees 6,75,889. Case 2. Licensed property. A residential premises of 1,800 square foot in a posh locality in Delhi is licensed on January 2008 for 5 years period and the license compensation is fixed as rupees 2 lakhs per month and rupees 25 lakhs was taken as deposit. Society maintenance charges come to rupees 10,000 per month and to be borne by the licensor. Calculate the value of the property on January 2011. The prevalent Market rate in the locality is rupees 25,000 per square foot. Assume appropriate rate of capitalization. The value as on 2011 is in two stages. One is the term income for 3 years. B is the reversion of the property after 3 years. Gross annual income is equal to 2 lakhs into 12 is equal to 24 lakhs. Deduct outgoing. Society maintenance 10,000 and 12 is equal to 1 lakh 20,000. So net annual income or yield is equal to rupees 22 lakhs 80,000. As for the Easement Act for licensed property, the Rent Act is not binding. The property will revert back to the licensor. The licensor will get the advantage of appreciation of the value of the property during the license period. This is an additional benefit and another yield to the licensor. As discussed earlier, 4% yield rate for the licensed property. Capitalizing net yield at 4% for 3 years, the value is equal to the net rental value rupees 22 lakhs 80,000 into the year's purchase in single rate 1 minus VV by R is equal to 22 lakhs 80,000 into 1 minus 1 divided by 1 plus 0.04, the whole raised to 3, the whole divided by 0.04, which amounts to rupees 22 lakhs 80,000 into 2.775 is equal to 63 lakhs 27,000. Reversion of the property after 3 years. Value of the property with vacant possession 1,800 into 25,000 is equal to rupees 4 crores 50 lakhs. This is the value of the property on vacant possession after 3 years. Present value of the amount receivable after 3 years at 8% is equal to the year's purchase is equal to the present value is equal to 1 by 1 plus R the whole raised to n. That is equal to 1 by 1 plus 0.08. That is 1 divided by 1.08 raised to 3 is equal to 0.7838. So the present value of the amount receivable after 3 years is equal to rupees 4 crores 50 lakhs into 0.7938 is equal to rupees 3 crores 57 lakh 21,000. The value of the property 4 crores 50 lakhs will be received only after 3 years. So here we are working out what will be the value of the rupees 4 crores 50,000 receivable at 3 years, the present value. That is rupees 3 crores 15,021, 56 lakhs 21,000. So total value is the term rupees 63 lakhs 27,000 plus the value rupees 3 crores 57 lakh 21,000, totaling rupees 4 crores 20 lakhs 48,000. Please note the reason for adopting a rate of return of 8% for the reversion instead of 4% for the licensed property. The rate of capitalization for rental income compensation amount considered as 4%, but for reversion a rate of 8% is adopted because it is not investment revenue income but investment to get back the property, because the set rate has to be close to remunerative rental. Case 3. Leased out property. A land of 2000 square meter was leased under private lease in the year 1985 for a period of 70 years. Lease rent rupees 5,000 per year. The lessee construct a residential building with several tenements and let out for rent, which yielded a rental income rupees 60,000 per year to the lessee. In the lease deed, there is a condition that on maturity of lease, the lease will be renewed for a further period of 70 years at a revised rent. What is the value of the leaser's interest in the property, assuming appropriate rate of capitalization? The leaser's interest in the property is the capitalized value of the lease rent. Since there is a renewal clause that the lease will be renewed for a further period of 70 years at a revised rent, the income will continue in perpetuity. Since the income from lease rent considered at a highly secured income, a rate of return of 7% is considered an adequate. Since lease rent is capitalized as 7% the perpetuity, as lease is a long lease. Lease interest is equal to 1 by R is equal to 5,000 divided by 0.7 is equal to 71,429. That is the leaser's interest. If you examine the above three case studies, you will find that the yield in case 1 is 9%, the case 2 is 4%, and the yield in the case 3 is 7%. So, you should understand that the yield depends upon the nature of occupancy and the statutory acts governing the occupancy, and on the basis of this, the rate of return or yield will change. To find out the yield rate in a real estate market. In a real estate market, the most important document is the sale deed. All the details of the property is available in the sale deed and the accompanying revenue records. It is necessary to check that there is no surplus unutilized FSI are left in sale instance property. It is also possible to find out yield rate from the sale of owner occupied or vacant properties. The valuer has to find out the actual sale price, including any black money transactions is involved in the transaction. Find out the gross rental income, deduct the outgoings, and from the net rental income, the yield rate is found out. In the case of flats, it is very easy that all the details are available in the sale deed by having a thorough inquiry in the market. The probable monthly rent receivable can be ascertained. The outgoing to society is available. So the net rental income can be worked out, and the yield rate of the rate and the rate of return can be worked out. Case studies, flats. Case 1. A businessman purchased a fully rented, fully developed 4-story building in Trivandrum for rupees 19 lakhs. There are 5 flats in each floor. The rent for the ground floor flat is rupees 800 per month per flat. First floor flat, rupees 850 per month per flat. Second floor flats, 900 per month per flat. And the third floor flats, rupees 950 per month per flat. The land tax is rupees 500 per year. The building tax is rupees 15,000 for 6 months. The water charges and electricity charges and service expenses are borne by the tenant. The building is 25 years old. Find out the rate of return if the Rent Act is applicable to the tenants. Solution. Gross annual rent. Rupees 800 plus 850 plus 900 plus 950. The monthly rent in each flat into number of flats in each floor, 5 into 12 months is equal to rupees 2 lakhs 10,000. Less outgoings. Land tax rupees 400. Building tax 12,000 for 6 months is equal to 24,000. Repairs and maintenance 15% is equal to rupees 31,500. Insurance 2% is equal to 4,200. Collection management 2% 4,200. So total outgoes is equal to rupees 64,300. So net annual yield is equal to rupees 2 lakhs 10,000. That is the gross annual rent minus the total outgoing rupees 64,300 is equal to rupees 1,45,700. So the rate of return is equal to 1,45,700 divided by 19 lakhs into 100 is equal to 7.6%, say 8%. For a rent controlled property, 8% rate of return is reasonable. In residential building, yield rate of 4% to 6% is considered as fair return when the Rent Act is not applicable and rent can be increased at regular intervals. Sometimes, in the case of rent controlled properties, also the rate of return is as low as 2% to 4% due to high maintenance costs and hike in the property tax. Case 2. An ownership flat of 600 square foot area is purchased in September 2015 for a sum of rupees 22 lakhs. Society outgoings are fixed at rupees 1,500 per month. On inquiry, it is found that the apartment can be licensed for rupees 12,000 per month. Find the yield rate on the investment for the purchaser. Solution. Annual rental income is equal to 12,000 into 12 is equal to 1,44,000. Less outgoing. Society charges 12 into 1,500 is equal to rupees 18,000. Other expenses, say 4%, is equal to 5,700. Total outgoing is equal to 23,760. So net income per year is equal to the gross income 1,44,000 minus total outgoings 23,760 is equal to 1,20,240. So rate of return is equal to 1,20,240 divided by 22 lakhs into 100 is equal to 5.45%. The return of 5.5% is quite adequate for licensed premises. Rent Act is not applicable, so rent can be increased at the time of each renewal. Development method. This method is followed for developing an undeveloped property in its highest and the best use when the property has a substantial potential for some form of profitable development. There are three methods of valuation of property under this development method. One, the traditional method, then the market approach, then the residual methods. This is the traditional method followed. Due to the development of different approaches and methods, the other methods followed are market approach and residual method. The first one, market approach, has been explained in detail in the forthcoming chapters on valuation approaches. Hence, we are discussing here only the residual method or residual technique. Residual techniques are further divided into two parts. Residual techniques for owner-occupied properties, residual techniques for tenant-occupied properties. First one, the residual technique for owner-occupied properties. In this method, the depreciated cost of the building or the scrap value of the building is deducted on the basis of actual sale price. This method is adopted to find out the net land value. This method of finding the land value from the sale price and value of building is established by the under-mentioned formula. R is equal to C minus S by A, where is equal to R, rate of land or the per unit area, C, sale consideration amount, S, scrap value or the depreciated cost of building. A is equal to total area of the plot. R is equal to C minus S by A. This formula can be understood clearly by working out the following example. An ownership flat of area 1200 square foot in an old building in a fully developed area in the city is sold for an amount of 2 crores. The FSI is equal to 2. The depreciated cost of the building is 25 lakhs. So, land rate is equal to 2 crores minus depreciated value of the property 25 lakhs divided by the area of the flat is equal to rupees 14,583 square foot. Land rate for FSI 2 is equal to rupees 14,583 into 2 is equal to rupees 29,166. But there is lot of difference of opinion among valuers in this method because there will be lot of error in assessing the depreciated cost of the building. But a competent and experienced valuer can estimate the depreciated value correctly. It depends upon the experience and the competency of the valuer. Case studies. Case 1. A rectangle-shaped level plot of 200 square meter with a building of plinth area 100 square meter is sold in January 2010 for rupees 1 crore 50 lakhs. The building is 25-year-old and the replacement cost is rupees 12,000 per square meter. Calculate the land rate in 2010 by residual technique. Present value of the building is equal to replacement cost minus depreciation. Replacement cost is equal to 100 square meter in the 12,000 is equal to 12 lakhs. Depreciation percentage is equal to 25 by 60 90 37.5%. So depreciation amount is equal to 12 lakhs into 0.3575 is equal to 4 lakhs 50,000. So depreciation present value is equal to 12 lakhs minus 4 lakhs 50,000 is equal to 7 lakhs 50,000. Land rate R is equal to C minus S divided by A. So it's equal to rupees 1 crore 50 lakhs minus the depreciated value of the building rupees 7 lakhs 50,000 divided by the area 100 square meter. So it's equal to rupees 1 lakh 42,500 per square meter in January 2010. A property 600 square meter land with a building 300 square meter and 45-year-old vacant house centrally placed in the plot is sold in the year 2015 for an amount of rupees 1 crore 60 lakhs. The FSI for the plot as per the corporation rules is 1.5. Find out the land rate by residual technique. Here it is seen in the plot the building is very old, 45 years, and is centrally placed. Hence, the full development is not possible without demolishing the building. The FSI of the plot has not been fully utilized. So the bungalow cannot be valued as a depreciated value. It can be valued only as scrap. If the replacement rate in 2015 is 10,000 per square meter, the scrap value for the salvage value will be 1,000 per square meter. So scrap value for 300 square meter is equal to 300 into 1,000 is equal to 3 lakhs. So land rate is equal to 1 crore 60 lakhs minus this scrap value 3 lakhs divided by the area 600 square meter is equal to rupees 26,167 per square meter. The sale price of the ownership flat depends upon so many factors: the price of the land component, the cost of the construction of the building component, interest on the investment, and the developer's profit. Hence, instead of the above mentioned, a more practical formula is adopted to find out the land price. The following formula is used generally to find out land price. Land price is equal to S minus P minus C. L is derived land rate or residual land rate. S is equal to sale price of the flat or premises. P is the profit of the developer. C is the cost of construction of the premises. Here the valuer must understand the following underlying expenses in each components of the above formula. P. The profit of the developer will include the administrative expenses, interest for loans taken, legal charges, brokerage if any paid for certain deals, expenditure for maintaining the staff and the proper office. See, the cost of construction is not only the actual construction cost but will include other outgoings. The full cost of construction of the building if it is a new construction, depreciated cost of construction if it's an old building, interest on expenses, professional charges for architects, structural engineers, expenses on account of obtaining the permit, municipal fee for building permit, municipal tax, land tax, etc. Water and electrical charges for construction, administrative charges, and the management expenses. So, sometime the very easy application valuers group these expenses into two groups. Example, if the developer profit is 20%, the breakup of the profit can be considered in the following method. Development profit 10%, burden on finance half period of construction 8%, other outgoings like brokerage illegal 2%, total 20%. The developer profit vary according to the locality where the premises is situated. In low-cost ownership premises, it may be sometimes 5% when compared to high-cost ownership premises where it may be from 20% to 30%. If you take an average profit of 15%, the breakup may be adopted as given below. Developer's profit 8%, interest burden on half the construction BD is 6%, outgoings 1% is equal to 15%. Also in the case of cost construction also, it can be divided into different categories of expenses. But please keep in mind these are all some assumptions with some data obtained by long experience in the field of construction. Suppose the cost of construction considered is rupees 15,000 per square meter. The breakup of may be divided as under. Actual building cost 12,750. Architect's fee 4% is equal to 600. Municipal charges, permits, etc. 3% is equal to 450. Management 5% is equal to 750. Miscellaneous expenses 450. Total come to 15,000. Case studies. Case 1. A developer sold a flat of area 175 square meter in a newly constructed apartment complex for rupees 1 crore 50 lakhs in the year January 2016. The prevailing building construction cost in 2016 is rupees 12,000 per square meter. What will be the land rate adopting residual technique if the FSI is 1.5? Selling rate of the flat is equal to 1 crore 50 lakhs divided by 175 square meter is equal to rupees 85,714 per square meter. S is equal to say 86,000 per square meter. Profit 20% of sale price is equal to 0.2 into rupees 86,000 is equal to rupees 17,200. Cost of construction C is equal to rupees 12,000 per square meter. Land component L in flat is equal to sale price by square meter minus profit per square meter minus cost of construction per square meter. S minus P minus C is equal to rupees 86,000 minus rupees 17,200 minus 12,000 is equal to 56,800 per square meter. The FSI is 1:5. For 1 square meter of flat, area of land utilized is equal to 1 divided by 1.5. That is equal to 0.666 square meter. Corresponding land rate is equal to 56,800 divided by 0.666 is equal to rupees 85,285 square meter. Case 2. In an industrial estate, one nail manufacturing unit of 225 square meter area in a 30-year-old building is sold in March 2014 for a price of rupees 40 lakhs. The prevailing rate for a new unit in the same industrial estate is rupees 20,000 per square meter. Cost of construction is found to be rupees 9,000 per square meter in 2014. Adopt developer's profit at 15%. Calculate the derived land rate for the plot A with 30 years old building and the new plot. Land rate is equal to 40 lakhs divided by 225 is equal to rupees 17,777 per square meter. Less 15% profit is equal to the 50% profit is equal to rupees 2,667 per square meter. Depreciated cost of building 9,030 by 60 into 0.9 is equal to 4,050. Land component in the sale price is equal to rupees 17,777 minus the profit 2,667 minus 4,050 is equal to rupees 11,060 per square meter. Sale rate of plot B is equal to 20,000 per square meter. Less 15% profit is equal to reduce 3,000. Cost of building is equal to 9,000. So land component on the sale price is equal to 20,000 minus 3,000 minus 9,000 is equal to 8,000 per square mile. If you analyze the two plots A and B, you can see that the land rate in the 30-year-old plot is more than the land rate in the B. Also, the profit is more in the old plot A when compared to the plot B. In real practice, the developer's profit in the actual market. This difference may not be due to the land rate as is seen in the example. It may be due to so many other factors of market force like better location, the rise in taxes in the new plot, extra price paid for new plot, higher maintenance charges for new plot, etc. It can be attributed to demand and supply and not due to the difference in land component. This is one of the reasons that why this method, which is an indirect way of arriving the land rate, is considered to be less accurate than direct sale comparison method of open plot. Two, residual technique for tenant occupied properties. In the case of tenanted properties, in the plot under construction, the tenanted property may be at the corner or sometime at the center. If the tenanted property is in the corner, a new building can be constructed without disturbing the tenanted building. Also, the tenanted building can be retained as it is. Also, in the another situation, the existing tenanted building is so placed that in the above two situation, an upper floor can be constructed without disturbing the existing tenants from the sale of properties upon the above two situations. The land rate can be reviewed using residual method, but if the tenanted building is centrally located in the plot situated, then we have to resort to hypothetical building scheme under the development method. Now we will take up the case under the first situation. Case 1. A property with 1500 square meter plot area with a 3-story rented building, 250 square meter in each floor, is sold for rupees 50 lakhs in the year 2014. FSI for the locality is 1.25. Total rent received from 9 tenants is rupees 6,000 per month. Find out the derived rate of land from the sale by residual method. Annual rental return or value is equal to rupees 6,000 into 12 is equal to rupees 72,000. Assuming a 8% return value of tenanted building as per rental method, the value is equal to 1 by 0.08 into 72,000 is equal to 9 lakhs. Total sale value is equal to 50 lakhs. Deduct building value 9 lakhs. So the net sale value is 41 lakhs. Unutilized balance FSI area is equal to 1501.25 minus 3 into 300. It's equal to 975 square meter. Land rate is equal to 41 lakhs divided by 975 square meter is equal to rupees 4,205. Please note here the following facts. The plinth area of the 3-story building is 3 into 250 is equal to 750 square meter. The prevailing FSI is 1.25 square meter. So, premises or the land area attributed to the plinth area of 750 square meter is 750 divided 1.25 is equal to 600 square meter. Is estimated at nil value assuming that it is uncontrolled property. Hypothetical building scheme or ownership concept. This method of land valuation is also indirect method of deriving the land rate by residual technique and not according to comparable sales synthesis method. According to the size of the plot, location and demand from the public, the valuer prepares a project report for a hypothetical building, a shopping complex or a hospital or a health center or villas or residential flats or commercial plots. The estimate for the investment is found out. Sale prices are decided, and from these data, the land rate is derived. Please note the hypothetical building scheme is entirely different from the hypothetical plotting scheme which is used for valuing large size plots. Case 1. A promoter constructed 10 flats of 950 square feet each in a plot area of 5,000 square feet. The prevailing building rate including all services is 2,500 per square foot. He sold one flat for rupees 65 lakhs. Assuming the promoter's profit as 15%, calculate the land rate by residual technique. Total area of flats, 10 flats is equal to 950 into 10 is equal to 9,500 square feet. Land area of the plot is equal to 5,000 square feet. FSI is equal to 2. Selling price of flat, that is land plus building plus profit, is equal to rupees 65 lakh. This is the composite rate. Unit rate of flat is equal to 66 lakhs divided by 950 is equal to rupees 6,947 per square foot. Promoter's profit is 10%. The land and building, excluding the profit, is equal to 6,947 divided by 1.15 is equal to rupees 6,041 per square foot. Deduct unit rate of building. Construction cost. Land component is equal to 6,041 minus the building cost of construction is equal to rupees 3,541 per square foot. FSI is 2. So land rate is equal to the land component rupees 3,541 into 2 is equal to rupees 7,082 per square foot. Case 2. Mr. X is owning a building of plinth area 2,500 square foot and 25-year-old in a plot of 4,000 square foot. The total life of the building is 60 years and salvage value 10%, replacement cost of building is and services is rupees 2,000 per square foot. The property was sold for rupees 70 lakhs. Calculate the land rate by residual technique. Building plinth area is equal to 2,500 square foot. Replacement rate is equal to rupees 2,000 per square foot. Replacement value is equal to 50 lakhs. Age of the building 25 years. Total life of building 60 years. Salvage value 10%. Depreciation percentage is equal to 25 divided by 60 into 90 is equal to 37.5%. Depreciation amount is equal to 50 lakhs into 0.375 is equal to 18 lakhs 75,000. So depreciated value is equal to rupees 50 lakhs minus 18 lakhs 75,000 is equal to 31 lakhs 25,000. Sale value, land plus building. The value for which the property was sold is 70 lakhs. Value of land alone 70 lakhs minus the depreciated value of the building is equal to 31 lakhs 28. So it is equal to rupees 38 lakhs 75,000 for 4,000 square foot of land. Extent of land is 4,000 square foot. So rate of land is equal to 38 lakhs 75,000 divided by 4,000 is equal to 969 per square foot. Case 3. A builder intends to purchase a property having a land area of 2000 square meter with a tenanted building in the plot having ground floor plinth area 600 square meter. Total rental income 3000 per month. FSI in the area is 1. Replacement cost of building 9500 per square meter. Present sale price of flats in the locality is 60,000 per square meter. Expected developer's profit is 15% on sale price. Interest on borrowed capital is 13% on 50% sale value for 1 year or half period of construction. Assuming settlement period with tenants at 2 years and legal expenses 1 lakh. Scrap value is 700 per square meter. Find out the fair price for the land purchase to be offered to vendors. The total built-up area under hypothetical building scheme is 2000 square meter. Tenants rehousing minimum 600 square meter. Net saleable area is equal to 2000 minus 600 is equal to 1400 square meter. Net realizable sale value is equal to 1400 into 60,000 per square meter is equal to 8 crore 40 lakhs. The actual area will be more than this since permissible balance area of FSI. This amount of rupees 8 crore 40 lakhs cannot be realized immediately. The project may take at least 2 years to complete, and sale of all the flats and full realization of estimated sale value will take time. So, we have to defer the value at 13% for the 1 year, that is half period of realization of the total sum. Deferring the value at 13% to 1 year, the net present value of realizable sum is equal to P into 1 divided by 1 plus R the whole raised to N. That's equal to P 8 crore 40 lakhs into 1 divided by 1.13 the whole raised to 1. Which is equal to 8 crore 40 lakhs into 0.885 is equal to 7 crore 43 lakhs 40,000. Total outgoings. The cost of construction of 2000 square meter at rupees 9500 per square meter is equal to 1 crore 90 lakhs. Developer's profit 15% of rupees 8 crores 40 lakhs is equal to 1 crore 26 lakhs. Interest at 13% on half of the investment of 8 crores 40 lakhs for 1 year. That is 13% of 4 crores 20 lakhs. That is half of 8 crores 40 lakhs, which is equal to 54 lakhs 60,000. Legal expenses 1 lakh. Total 3 crores 71 lakhs 60,000. Net income in project is equal to 7 lakhs 43 rupees 7 crores 43 lakhs 40,000 minus the outgoings rupees 3 crores 71 lakhs 60,000, which is equal to rupees 3 crores 71 lakhs 80,000. Total income is equal to rupees 3 crores 71 lakhs 80,000 plus the scrap value. As already given in the question, the scrap value is 600 square meter into the scrap value rate is 700 per square meter, which is equal to 4,20,000. So total income is equal to rupees 3 crores 71 lakhs 80,000 plus 4,20,000 is equal to 3 crores 76 lakhs. So rate of land is equal to rupees 3 crores 76 lakh divided by 2000 is equal to rupees 18 lakhs 800 per square meter. Profit method. In the earlier chapters, we have discussed the land and building method, composite rate method, rent capitalization method, and development method. Now in this chapter, we are discussing about the profit method. In fact, the profit method is one of the methods which comes under income approach. It is similar to yield method. Instead of rental income, future flow of profit is forecast and they capitalized to arrive at present value of the assets. The investors acquire several types of properties like hotels, cinema theaters, marriage halls, shopping mall, multiplex theaters, petrol pumps, hospitals, clinic, commercial properties which are run for multi-purpose profits. These properties can be valued as per land and building method also. But it is common experience that these commercial properties fetch higher price in the market due to the higher margin of profit, the added value of goodwill when compared to the value arrived by land and building method. Hence, valuation of such business establishments should be done preferably by profit method rather than other methods of valuation. But sometimes, if the business is not conducted in the proper way or if there is mismanagement in the business and the buildings have become very old, the profit method may give a lower value, and in that case it is better and appropriate to value the property as per land and building method. The profit method will be more easy to understand if you work out the examples and some case studies. So let us see the case studies of profit method. Case 1. A is a dealer of a petrol bunk situated on the prime locality and he gets a ground rent from the petroleum company. Details of the petrol outlet, his income and expenses and conditions of contract are detailed below. Income from petrol bunk per year. Sale of diesel 4 lakhs liters at rupees 73 per liter. Sale of petrol 3 lakh liters at rupees 80 per liter. Lease rent paid by the petrol company for the land is equal to rupees 5 lakhs per year. Sale of lubricants and spare parts 6 lakhs per year. Profit of sale of goods is equal to 12.5%. Number of cars serviced per year is 1,800. Charges levied for servicing cars, rupees 750 per car. These are the income. Then expenditure in an year. Cost of petrol purchase 75 per liter. Cost of diesel purchase 68 per liter. Salaries of staff rupees 60,000 per month. Property tax rupees 40,000 for 6 months. Electricity charges 45,000 per year. Telephone, postage, stationery 25,000 per year. Maintenance 25,000 per year. Insurance premium 10,000 per year. Grease, oil, consumable for car service rupees 60 per car. Miscellaneous expenses rupees 40,000 per year. Rate of return is 12%. Calculate the total income for the dealer. Calculate the total expenses for the dealer. What is the net profit for the dealer? What is the year's purchase if the rate of return is 12%? What is the value of the property for the purpose of purchasing assuming a rate of return of 12%? Total income. Diesel sales 4 lakhs liters at rupees 73 is equal to 2 crores 92 lakhs. Petrol sales 3 lakhs liters at rupees 80 per liter is equal to 2 crores 40 lakhs. Ground rent received from the petrol company rupees 5 lakhs. Sale of oil lubricant spare parts 12% of 6 lakhs is equal to 75,000. Income from servicing of cars 1,800 cars into 750 is equal to 13 lakhs 50,000. Total income per year rupees 5 crores 51 lakhs 25,000. Now the expenses. Cost of petrol purchased 3 lakhs into rupees 75 is equal to 2 crores 25 lakhs. Cost of diesel purchase 4 lakhs liters at rupees 68 per liter is equal to 2 crores 72 lakhs. Salaries of staff 12% of 60,000 per month is equal to 7 lakhs 20,000. Property tax 2 into 40,000 is equal to 80,000. Electricity charges 45,000 per year is equal to 45,000. Telephone and postage etc. 25,000. Maintenance 25,000. Insurance premium per year 10,000. Grease oil consumable for service for 1,800 cars into 60 rupees per car is equal to 1,08,000. Miscellaneous expenses rupees 40,000. Expenses for sale of lubricants is equal to 6 lakhs into 87.5%, that is equal to 5 lakhs 25,000. Total expenses is 5 crores 12 lakhs 78,000. So net profit is equal to rupees 38 lakhs 47,000. Years purchase. Rate of capitalization is 12%. Years purchase is equal to 1 by R is equal to 100 divided by 12% is equal to 8.33. Value of the property for purchasing. Capitalizing at 12% yield value of business is equal to the annuity rupees 38 lakhs 47,000 into 100 divided by 12 is equal to rupees 3 crores 20 lakhs 58,333. Say purchase price rounded to 3 crores 21 lakhs. Case 2. A vacant plot of 1,500 square meter in a highway is proposed to be taken up by a petrol company on lease. The land rate is rupees 5,000 per square meter. Calculate the lease rent if the yield is 7%. Extent of land 1,500 square meter. Land rate is equal to 5,000 per square meter. So value of land is equal to 1,500 square meter into 5,000 is equal to 75 lakhs. yield or rate of return is equal to 7%. So lease rent per year is equal to 75,000 into 7% of that, which is equal to rupees 5,25,000. Case 3. The daily rental charges of a Kalyana Mandapam in Trivandrum city is rupees 30,000, and there will be bookings only at 50% in the year. The outgoing expense in the year are property tax rupees 30,000 for 6 months, staff salary 50,000 per month, annual premium for insurance 40,000, repairs and maintenance rupees 2,25,000 per year, electricity rupees 50,000 per month, miscellaneous expenses 25,000 per month, management expenses rupees 1 lakh per month. Calculate the value of the property by profit method, assuming an yield of 12%. The gross income, daily rental charges 50,000, yearly rental charges 365 into 50,000. We expect an occupation of only 50% in a year. So gross income will be 50% of 30,000 into 365, which is equal to rupees 54 lakhs 75,000. Outgoing expenses, property tax 2 into 30 is 60,000, staff salary 6 lakhs, insurance 40,000, repairs and maintenance 2 lakhs 25,000, electricity 6 lakhs, miscellaneous expenses 12 into 25,000 is equal to 3 lakhs, management expenses 12 into 1 lakh is equal to rupees 12 lakhs, total expenses is equal to 30 lakhs 25,000. These are some of the few case studies under profit method of valuation. The profit method of valuation in full can be discussed in detail only after understanding the income approach in valuation and details of valuation under lease rent, years purchase, etc. These particulars are explained in detail in the presentation Property Valuation of Beginners Part 4, along with the valuation approaches like income approach, market approach, and cost approach. And before coming to the details of these valuation approaches, the basic knowledge of the technical terms used like market rent, rack rent, etc., and the leasehold details have to be studied in full. Hence, these details are detailed in Part 4, which will be uploaded soon. I extend my courtesy and gratitude to Sri R.K. Gandhi, Sri Smail Datta, and Sri P. Kanagasabhabadi for some extracts taken from their book on valuation. Please express your frank opinion, your likes and dislikes, but about this presentation, and subscribe my channel at the earliest. Thank you.